Hey everyone, welcome back to the channel. Today, we're going to dive into a strategy that many successful investors use to create passive income, dividend investing. If you've ever wanted to learn how to make money while you sleep, this video is for you. Let's start with the basics. Dividend investing is a strategy where you invest in stocks of companies that pay dividends. Dividends are payments made by a company to its shareholders, usually from its profits. By holding shares in dividend-paying companies, you can earn regular income without having to sell your stock. For example, if you own shares in a company that pays a 4% dividend and you've invested $10,000, you'll earn $400 per year in dividends just for owning those shares. So why do so many people love dividend investing? Here are a few reasons. Passive income. Dividends are a source of steady, predictable income. Unlike the price of a stock, which can fluctuate, dividend payments tend to be more stable. Compounding effect. If you reinvest your dividends, you can buy more shares and earn even more dividends, leading to a snowball effect of growth. Lower risk. Dividend-paying companies are often well-established, financially stable companies that have a track record of consistent performance. Potential for long-term wealth. Many investors use dividend stocks as part of their retirement strategy because they offer both income and the potential for capital appreciation. Let's break down an important concept, the dividend yield. The dividend yield is a percentage that tells you how much a company pays in dividends relative to its stock price. You can calculate it by dividing the annual dividend by the stock price. For example, if a stock is priced at $100 and pays an annual dividend of $5, the dividend yield is 5%. The higher the yield, the more income you'll generate for every dollar you invest. An easy way to grow your dividend income over time is by enrolling in a dividend reinvestment plan, DRIP. Instead of receiving your dividends as cash, a DRIP automatically reinvests them back into more shares of the same stock, allowing your investment to grow faster through compounding. The best part is, DRIPs are typically offered by most financial institutions free of charge. There are no commissions or fees to reinvest your dividends, so you can maximize your returns. Many long-term investors choose to use DRIPs because they don't need the dividend income immediately, and they're focused on growing their wealth over time. Let's go over a quick example. Say you invest $10,000 in a company with a 4% dividend yield. In the first year, you'll earn $400 in dividends. If you reinvest those dividends, and assuming the stock grows at an average of 5% per year, your investment could grow to over $32,000 in 20 years. That's the power of compounding, combined with dividend investing. One important thing to consider is taxes. In general, dividends are considered taxable income, but they can be more attractive than other types of income due to potential tax advantages. In Canada, dividends from Canadian corporations may qualify for the dividend tax credit, which can reduce the tax you pay compared to regular income as it helps avoid double taxation. In registered accounts like a TFSA or RRSP, dividends can grow tax-free or tax-deferred. In the United States, qualified dividends are generally taxed at lower rates than regular income, provided they meet certain conditions, while ordinary dividends are taxed at your regular income rate. Using tax-advantaged accounts like an IRA or 401k can defer these taxes. Not all dividend-paying stocks are created equal, so here are a few things to look out for when choosing your dividend stocks. Dividend history. Look for companies that have a consistent history of paying and growing their dividends. This shows financial strength and a commitment to shareholders. Payout ratio. This ratio tells you how much of a company's profits are paid out as dividends. A payout ratio below 60% is generally considered healthy, as it shows the company is retaining enough profit to grow the business. Industry stability. Stick to companies in industries that are stable and have a history of withstanding economic downturns, like utilities or consumer staples. A great example is Coca-Cola, which has been paying dividends for decades and is known as a dividend king, meaning it has increased its dividend for over 50 consecutive years. Coca-Cola has a global presence and strong brand loyalty, which gives it a steady stream of income, allowing it to not only pay dividends, but to increase them consistently, even in challenging market conditions. This kind of reliability is what makes companies like Coca-Cola ideal for dividend investors looking for stability and long-term passive income. Let's be honest, picking individual stocks is not everyone's cup of tea. If you find picking individual stocks hard, risky, or time-consuming, there is another option: investing in dividend ETFs or index funds. These funds provide an easy way to invest in a wide range of dividend-paying companies without the need to select individual stocks yourself. They typically offer diversification, reducing the risk associated with holding a single stock. Look for funds that focus on companies with a history of consistent dividend payments. A popular example is the Vanguard Dividend Appreciation ETF, which focuses on companies with a history of increasing dividends over time. Another great choice is the Schwab U.S. Dividend Equity ETF, which offers exposure to high-quality, high-yielding U.S. companies. iShares Select Dividend ETF is another option, targeting high-yielding stocks across different sectors. Dividend ETFs are also a great choice for passive investors because they're professionally managed and require little oversight. Plus, just like with individual stocks, you can reinvest the dividends through DRIPs, allowing you to compound your returns over time. That's a wrap. Dividend investing is a powerful strategy to build wealth and generate passive income over time. Whether you're saving for retirement or just want to supplement your income, dividends can provide a steady stream of cash flow while letting you participate in the stock market's growth. If you found this video helpful, please give it a thumbs up and subscribe for more investing tips. Thanks for watching, and see you in the next video.